Let me ask you something. If I told you that we could predict the future, would you believe me? No, not with tarot cards or crystal balls, but with math. I'm Bennett, and with my research partner Matthew, we worked on a study called Evaluating ARIMA, SARIMA, and Holt Winters for time series-based stock forecasting. So why did we choose this topic? Predicting stock prices helps investors spot trends, manage risks, and make better decisions. As students, many of us started to think about our finances, maybe even trying investing. Stocks can be a smart way to grow money, but only if you know what you're doing. The problem, stock data is messy. It's noisy, non-linear, and unpredictable. Different stocks behave differently. Some move fast and others remain stable. So that's why we did this research, to see if time series forecasting can reliably predict stock prices in real-world scenarios. We compared ARIMA, SARIMA, and Holt Winters to see how well each performs on different types of stocks. Alright, now let's get into the data. We collected daily closing stock prices from Yahoo Finance using the Y Finance package covering 2 to 5 years. Since Holt Winters needs regular intervals, we aligned data to business days with aspect B and filled in gaps like holidays using linear interpolation, ensuring consistent patterns for accurate forecasting. And how did we decide which stock is fast, slow, or stable? We used 3 common indicators. The first one is RSI, or Relative Strength Index. If the RSI was above 70, we marked it as fast-moving due to the strong momentum. We also used Simple Moving Average 200 because if the current price was within 2% of its 200-day average, it's likely a slow mover stocks. Then we used 20-day rolling standard deviation. If the volatility was above 3%, we labeled it as fast-moving. If it's under 1%, we label it as stable. And if it's between 1 to 3%, we label it as slow-moving. So by combining these indicators, we could label each stock accordingly before testing the models, and gave us a balanced view of different market behaviors. Now, before feeding this data into our models, we had to clean and prepare it. For ARIMA and SARIMA, we needed to make sure the data was stationary, meaning the mean and variance stay constant over time. We tested that using the ADF test. If the data wasn't stationary, we applied differencing. Then, to tune the models, we used ACF and PACF plots to help us decide on the P, D, and Q parameters for ARIMA and also the seasonal parts for SARIMA. As for Holt Winters, it requires regular time intervals. So again, we use linear interpolation and set the frequency to business days to make sure everything aligned properly.
Okay, let's start with the models. The first one is ARIMA, Autoregressive Integrated Moving Average. It has 3 parameters, P, D, and Q. P is how many past values we look at, and D is how many times we difference the data to make it stable, and Q is how much we use past forecast error to ARIMA. ARIMA works real well when the stock is stable or slowly moving. Next, SARIMA or Seasonal ARIMA. It extends ARIMA with 4 more seasonal parameters, P, D, Q, and S. This allows it to capture repeating seasonal patterns like weekly or monthly cycles. That's why SARIMA is better when stocks move fast or show cyclical behavior. And finally, Holt Winters. We use the multiplicative Holt Winters since stock price usually have proportional ups and downs, bigger price and bigger swings. It has 3 key components: level, trend, and seasonality. It's quick and easy but less accurate when data gets too noisy. So how did we do the forecasting step? First, we split the data 80% for training and 20% for testing. For ARIMA and SARIMA, we use a step-by-step forecast, predict one day, feed the prediction back in, then move to the next day, and so on for 5 days. Holt Winters works differently. It forecasts all 5 days in one go, using its smoothing states. After that, we measure performance with 4 metrics, MAE, MSE, RMSE, and MAPE, to see which model was more accurate and more consistent.
Now, once the model were trained, How did we check if they were any good? We used 4 evaluation metrics. The first one is MAE, the average error, plain and simple. The second one is RMSE, gives it more weight to the large errors. MSE, basically RMSE before taking the square root. And the last one is MAPE, shows the error as percentage, which makes it easier to interpret. Lower numbers on all of these means better performance. Now let's talk into the results and discussion. And here's where it gets interesting. For slow-moving stocks, ARIMA and SARIMA both perform really well, with SARIMA MAPE as low as 0.7%. But the best model is still dominated by ARIMA. Holt Winters, not even close. Sometimes its error was over 18%. With stable stocks, again, ARIMA dominated, giving us a MEPE score as low as 0.89%. SARIMA did fine but didn't outperform. So in cases where seasonal patterns weren't strong, the simpler ARIMA model was just more efficient. Here in fast-moving stocks, SARIMA started to shine. It managed to capture some of the cyclical volatility, giving us a MAPE score as low as 0.73%. And again, Holt Winters completely broke down. It just couldn't handle the noise and volatility. So, what does this all mean?
So, from the result, ARIMA came out best for stable and slow-moving stocks, simple model and simple patterns. SARIMA was slightly better for fast-moving stocks since it handles seasonal and complex behavior. Holt Winters, even the multiplicative one, had higher errors, so it less suitable for very volatile prices. And there are some limitations. We only use closing price, no extra info like trading volume or news. Also, ARIMA and SARIMA both assume linear relationship, so they can miss non-linear or sudden movement in the market. So, what's next for the future works? First, we want to combine ARIMA and SARIMA with deep learning models like LSTM, so we get the best of both worlds, statistical patterns and nonlinear learning. Second, we want to try multivariate forecasting. That means not just looking at the closing price, but also adding features like trading volume, technical indicator, or even news sentiment. And finally, we want to test the model in other markets and sectors, for example in forex, commodities, or tech stocks, to see if the finding still holds.
In the end, our study shows that forecasting models can support smarter, data-driven decisions in an uncertain stock market. Thank you.